Ladies and gentlemen, Asian guy here. Happy holidays. But I need to cut straight to what's happening right now because we're officially in the danger zone. The clock on your screen reads December 1st, 2025. That means we have exactly 36 hours until the world changes. 72 hours until January 2nd when Chinese export licensing restrictions become enforceable law. But here's what you need to understand immediately. We don't have to wait until Friday to see the destruction. The destruction is already unfolding in real time. And if you're still checking the COMEX ticker thinking you understand what's happening to silver, you're about to get educated on how markets break. Right now, at this exact moment, there's no longer one price for silver. The global market has shattered into three completely separate pricing tiers, and the gap between them is widening by the hour. Let me show you what I mean. Tier 1 is what I'm calling the panic price. This is Shanghai. The Shanghai Futures Exchange closed its final session of the year at an equivalent of $84.55 per ounce. This is the price being paid by the world's manufacturing capital, the entities that actually need physical metal to build solar panels, batteries, and electronics. These aren't speculators. These are industrial giants who understand that in 72 hours, the export gates slam shut. They're paying whatever it takes to secure inventory before the deadline. Tier 2 is what I call the honest price. This is the physical market in the Middle East. We've confirmed live transaction prices in Dubai's physical souks, averaging $79.61 per ounce. This is outside the panic zone of China, but still reflecting genuine physical scarcity. This is real buyers and real sellers exchanging actual metal. They're demanding nearly $8 over the supposed spot price. And then we have Tier 3, the ghost price. This is COMEX in New York, currently showing $72.15 per ounce. Let me walk you through the math here because this number should be physically impossible. Shanghai, $84.55. New York, $72.15. Spread, $12.40. That's a 17.2% premium between the East and West. In any functioning global commodity market, a 17% spread on fungible metal would trigger instant arbitrage. Banks and hedge funds exist specifically to close gaps like this. Buy in New York at $72. Sell in Shanghai at $84. Pocket the $12 difference, risk-free. But they're not doing it. The spread isn't closing. In fact, it's widened from $5 yesterday to $12.40 today. Why? Because the arbitrage is dead. The sophisticated traders understand that even if they buy silver in New York today, they cannot physically transport it, clear customs, and deliver it to Shanghai before January 2nd. The deadline has made the bridge impassable. New York has become an island of paper contracts that nobody trusts. The real world, the world of factories, strategic reserves, and actual consumption, is trading at $84.55. When you see $72.15 on your screen, understand that you're looking at a fiction. You're looking at the price of a paper promise that the physical market has completely rejected. The COMEX has lost its role as global price setter. It's now just the price suppressor that the physical world is learning to ignore. But the pricing breakdown is only the symptom. The real disease is happening in the delivery system, and what we're seeing there is absolutely unprecedented. Remember yesterday? We analyzed the delivery data and mocked how tiny it was. Out of billions of ounces traded on paper, only 69 contracts stood for physical delivery. That's 345,000 ounces. Pocket change in this market. We said it proved the market was purely speculative gambling with no real demand. Well, that just changed violently. The preliminary delivery notices for December 31st just came through, and the number is shocking. 1,847 contracts standing for delivery. Let me do this math with you. 1,847 contracts times 5,000 ounces per contract equals 9,235,000 ounces. 9.2 million ounces demanded for physical delivery in a single session. Compare that to yesterday, 345,000 ounces. 9,200,000 ounces. That's a 26-fold increase in physical demand in just 24 hours. This isn't a normal market fluctuation. This is a bank run. This is a raid on the vault. What this tells us is that nearly 2,000 large entities, pension funds, industrial giants, sovereign buyers, looked at the calendar, saw January 2nd approaching, and simultaneously hit the deliver button. They're no longer willing to hold paper exposure. They're converting contracts to bars before the window closes. Think about the game theory here. If you're a fund manager holding silver futures, And you know that in 72 hours, the Chinese supply disappears. What do? You demand delivery today at $72.15 because you understand that the metal you're claiming is already trading at $84.55 in the real world. You're buying dollars for 85 cents? It's the trade of a lifetime, but only if you can get the physical metal out of the vault right now. This 26-fold spike in delivery is the system trying to correct itself through force, and it's absolutely crushing the banks on the other side of these trades. Imagine you're a bullion bank that sold those 1,847 contracts. You thought you were just providing liquidity. You thought the buyers would roll their contracts forward like they always do. Instead, today, they're demanding 9.2 million ounces of actual metal. Where are you going to find it? Shanghai is closed to you. Dubai is charging $79. Your own vaults are running low because you've been bleeding inventory for weeks. You're trapped. And this delivery spike is exactly why the banking system is hemorrhaging cash right now. It's why the Federal Reserve had to step in again today with another emergency operation. If you thought yesterday's $3 billion injection was a one-time Band-Aid, the data from this morning proves the wound isn't healing. It's getting worse. The Federal Reserve executed a second emergency repo operation today, December 31st. The size? $2.8 billion. Add that to yesterday's $3 billion, and we're looking at $5.8 billion of emergency liquidity pumped into banking plumbing in just 48 hours. To put that in perspective, that's enough cash to buy 80 million ounces of silver at current prices. The banks burned through it in 2 days just to stay solvent. Why do major banks need $6 billion in overnight cash right now? Because of that delivery spike we just discussed. But you need to understand the mechanics of how this creates a liquidity death spiral. When those 1,847 contracts stood for delivery today, the banks on the other side, likely JP Morgan, Citi, Bank of America, faced two terrible choices. Choice A, deliver metal from their own vaults. But their vaults are nearly empty, and they're terrified of draining them completely before the Chinese export ban takes effect. Choice B, go into the open market and buy silver immediately to fulfill the delivery obligation. But here's the fatal problem with choice B. The open market is broken. If they try to buy in Shanghai, they pay $84.55. If they buy in Dubai, it's $79.61. But they sold these contracts at $72.15. They're locking in catastrophic losses on every ounce delivered. They're buying high and delivering low, which instantly destroys their cash reserves. So they run to the Fed's repo window to borrow emergency cash to cover the spread and finance the settlements. The $5.8 billion is the cost of the spread. It's the price tag for keeping the game running for another 48 hours. And we're seeing the stress fractures appear in individual bank operations. JP Morgan has quietly increased loan loss provisions for its commodities division by $400 million overnight. You don't provision $400 million unless you know a storm is hitting your balance sheet right now. Citi insiders report that unprecedented physical delivery requests are clogging their settlement systems. Clients requesting metal are being told it will take administrative time, which is bank code for we don't have it and we're scrambling to find it. Bank of America has extended delivery timelines from the standard 2 days to nearly 2 weeks for large orders. Why the delay? Because they're desperately trying to source metal from London, from ETFs, from anywhere they can find it. This is textbook bank run dynamics. Except instead of people lining up at ATMs to withdraw $20 bills, it's industrial giants lining up at COMEX to withdraw 1,000-ounce bars. The banks are insolvent in metal. They have dollars. The Fed just gave them $5.8 billion worth. But dollars can't print silver. This is the fatal flaw in their suppression scheme. They controlled the price with paper leverage for years, but leverage works both ways. When it snaps back, it destroys whoever's holding it. And think about the timing. It's New Year's Eve. Normally, repo markets are dead quiet on December 31st. Banks want to clean books before the holiday. For the Fed to be this active and for banks to be this desperate for cash on the last day of the year tells you the panic is acute. They can't wait until January 2nd. They need liquidity now. This $5.8 billion is the invisible proof of the crisis. The screen says 72, so you think everything's calm. But the Federal Reserve's balance sheet says $5.8 billion emergency injection, which tells you the building is on fire. While banks in New York are burning cash trying to patch delivery obligations, the situation in Shanghai has accelerated from concerning to catastrophic. If you thought yesterday's 41-ton withdrawal was extreme, today's update is going to shock you. An additional 43 tons of silver were withdrawn from Shanghai Gold Exchange during the December 31st session. Combined with yesterday, 84 metric tons removed in 48 hours. Let me translate that. 84 tons equals roughly 2,700,000 troy ounces. gone, removed from registered inventory, loaded onto armored convoys, and taken into private possession. To understand how abnormal this is, the Shanghai Exchange typically sees 2 to 3 tons per day in withdrawals during normal conditions. We're currently seeing 42 tons per day. That's a 1,400% increase in physical offtake. This isn't industrial consumption spread across factories. This is panic hoarding. This is strategic entities looking at the 72-hour countdown and deciding to drain the vault completely before the deadline. The impact on total inventory is devastating. 2 days ago, 755 tons. Today, 727 tons. They're draining 3.5% of the entire exchange inventory every single day. If this rate continues, and there's no sign it will stop, the Shanghai Gold Exchange will be mathematically empty in less than 1 month. But it won't take a month because markets don't go to zero in straight lines. They snap. When inventory drops below certain psychological thresholds, usually around 500 tons, the panic goes exponential. Buyers realize there's not enough for everyone, so they double their orders. The vault run accelerates. We're watching the beginning of that exponential curve right now. Who's taking this metal? It's not retail. You don't withdraw 84 tons in coin form. This is the state. This is strategic reserves. This is battery manufacturers like KTL and BYD. These are entities with inside information who know exactly how strict the export licensing will be on Friday. By withdrawing 84 tons in 48 hours, they're telling us they expect the supply chain to freeze completely. They're engaging in preemptive resource capture, securing atoms before politicians secure borders. And this creates a terrifying feedback loop for the West. Every ounce leaving Shanghai is an ounce that can never be arbitraged back to London or New York. It's permanently removed from the global float. The Western banks we discussed, the ones short millions of ounces, are watching this inventory collapse and panicking. They were counting on that metal. They hoped China would export some silver to cool down global prices. China is doing the exact opposite. They're locking it down. This 84-ton vacuum is the physical manifestation of the price split. Silver is $84.55 in Shanghai because only 727 tons remain, and everyone wants them. Silver is $72.15 in New York because nobody believes COMEX has the metal anyway. The hoarding isn't just happening at exchange vaults. It's cascading down to corporate procurement departments at companies you know. For 20 years, global manufacturing ran on just-in-time supply chains. You don't hold inventory. You order exactly what you need for this week's production, and the truck arrives exactly when the assembly line needs it. Beautiful system, efficient, maximizes cash flow. But just-in-time has a fatal assumption that you can always get what you need when you need it at the price you expect. Today, that assumption died. According to Asian supply chain sources, Samsung has executed emergency procurement orders to secure 6 months of silver supply in advance. Think about that shift. Usually Samsung holds maybe 2 weeks of inventory. Overnight, they've decided to hold 26 weeks worth. They're removing half a year of demand from the market immediately. Why? Because they see the 84-ton drain. They see the export ban 72 hours away. They know that without silver, they cannot manufacture a single circuit board or smartphone screen. For Samsung, paying a $5 or $10 premium is irrelevant. Silver is a fraction of a phone's cost. But zero silver means bankruptcy. We've also seen internal memos from Tesla's procurement division, specifically their solar and EV battery segments, labeling current silver inventory levels as critical. The memo reportedly authorizes buyers to pay above spot to secure immediate physical delivery. This is the smoking gun. When Tesla tells procurement to ignore spot price and just secure the metal, the spot price becomes meaningless. Tesla is bidding against Samsung. Samsung is bidding against Apple. They're all fighting for the same shrinking supply pool. And the Chinese solar manufacturers, who control 80% of global solar panel production and whose new TOPCon technology uses 50% more silver per panel, are the ones standing for delivery on Shanghai exchanges right now. This is strategic resource capture disguised as market activity. China is ensuring that while the rest of the world starves for silver, they'll have enough to dominate the energy transition for the next decade. But the disconnect isn't just in corporate boardrooms, it's hitting Main Street. If you think silver costs $72.15 because that's what CNBC shows, try to actually buy an ounce for that price. Go ahead. Try. You can't. The current premium on U.S. Silver Eagles has exploded to over $12 above spot. That puts the real acquisition price at roughly $84. Does that number sound familiar? It should, because $84 is the exact price Shanghai is trading at. The paper market says $72. The physical market in Shanghai says $84. Your local coin dealer says $84. The market has already repriced silver. The only entity that hasn't admitted it yet is COMEX. Canadian maples, which usually trade at $2 to $3 premiums, are commanding $10 premiums. Even generic rounds, basic lumps of silver with no collector value, are trading $8 over spot. Normally, generics trade 90 cents over spot. An $8 premium represents an 800% increase in physical acquisition costs. The dealers know they can't replace inventory at $72. If they sell you a coin today, they might pay $80 to get another one next week. So they're pricing in the future. They're pricing in the shortage. And we're seeing wholesalers, the suppliers behind major dealers, halt sales entirely. Inventory is disappearing from websites. You'll see out of stock or pre-order 6 weeks everywhere. 6 weeks is code for we don't have it, and we hope we can source it before you sue us. When you see 6-week delays in a volatile market like this, it means mints are backed up, refiners are empty, and the system is gridlocked. So here's where we stand. We have Samsung buying 6 months of inventory, Tesla scrambling for critical supplies, Chinese solar companies draining Shanghai vaults, retail market charging $12 premiums just to part with a single coin. This is total rejection of the paper price. The entire world, from Fortune 500 CEOs to local coin stackers, is voting with their wallets, and the vote says silver is worth $84, not $72. The only entities still trading at $72 are high-frequency algorithms on COMEX who never take delivery, but even they're starting to demand the metal. Even paper traders are trying to cross into the physical world, and the bridge is burning. Here's what happens in the next 72 hours. Phase 1, the last train. Next 12 hours. We have less than 12 hours before global markets shut for the holiday. Shanghai closes in hours. COMEX closes this afternoon. This is the final liquidity window. The last chance for paper shorts to cover before the rules change. The last chance for anyone to secure physical metal before premiums explode again. Don't be surprised if you see one final violent move. Banks might smash to $70 to trigger stops, or they might capitulate to $75. The price doesn't matter. Possession matters. Once the closing bell rings tonight, the doors lock. The train leaves the station. Phase 2, the void. January 1st. Markets are closed. Screens are dark. Ticker is silent. But make no mistake, this will be the most stressful day in bullion banking history. While the public celebrates, risk managers at JP Morgan and Citi will be in emergency sessions, staring at the 84-ton hole in Shanghai and the 9.2 million ounces they owe. Thursday is when industrial panic goes into overdrive. When Samsung and Tesla CEOs make off-market calls to refiners, bidding for metal in the dark at premiums that would shock you. We won't see these prices on charts, but we'll feel them Friday. Phase 3, Silvergeddon, January 2nd. The opening bell rings. Export ban is active. Licenses are required. Borders are sealed. My forecast, we'll see a gap up of historic proportions. The paper market cannot open at $72 when physical is at $84 and supply is severed. Algorithms will try to close the gap instantly. We could see silver open at $78, then $80, then $82, trying to teleport to the real price. But price isn't the danger. Force majeure is. Watch for notices from dealers declaring unforeseeable circumstances prevent contract fulfillment. Polite code for we're defaulting. They'll offer cash settlement. Here's your $72 back. But clients don't want $72. They want metal now worth $84. This is when class action lawsuits begin. But when the paper market loses all credibility, the spread might hit $15 or $20. Dealers will move to no offer status. The spot price becomes a museum exhibit, existing only on New York computer screens, completely detached from reality. For 40 years, wealth was stolen from physical holders by paper manipulators. They used leverage to suppress prices and hide real value. But in the next 72 hours, gravity takes over. China removed the physical buffer. The Fed exhausted the liquidity buffer. Industrial buyers exhausted the inventory buffer. There are no buffers left, only naked supply and demand. So my final message before the new year, don't look at red candles and feel fear. Feel pity for those selling real assets for paper currency being printed by the billions to cover bank failures. You're holding the asset Samsung needs, the asset Tesla needs, the asset China is hoarding. You're holding what cannot be printed, hacked, or defaulted on. The era of paper silver ends in 72 hours. The era of strategic silver begins Friday morning. The countdown is running. Hold fast. Get ready for the repricing of a lifetime. Asian guy here, and subscribe, like, and share.